Welcome to Refinitiv LPC's Middle Market Podcast. My name is David Brooke, a middle market reporter at LPC Refinitiv.
I'm David Puchowski, Director of Market Analysis at Refinitiv LPC.
And I'm Andrew Hedlund, also a private credit reporter at Refinitiv LPC.
We are now at the end of the first quarter of 2021, and it looks very different from this period at the same point last year. Vaccinations are now being put on across the country at a rapid pace, and so you can be forgiven for many people to now see the light at the end of the tunnel, especially for your middle market lenders. But with many kind of still difficulties in the economy, and with still many companies still reeling from the impacts of the coronavirus, is that light perhaps the sight of another train? To discuss this and some of the kind of thoughts that are going on in the market, I turn to David to discuss a recent survey produced by LPC Refinitiv.
Yeah, thanks, David. We polled lenders over the last couple weeks, and what they responded with as far as, were they able to lend as much as they wanted to in 1Q21, 56% said that they were not able to lend. But as you can see in the chart, that's kind of split very much between banks and direct lender responses. The direct lenders were much more 50-50 with their answers. And some of the lenders that said yes, they were able to lend as much. They said strong overall deal flow with core sponsors, and that carryover from 4Q20 momentum with new deal flow. While some of the lenders that responded no, they said that their pipeline decreased after a strong 4Q. So a little bit of a split there between banks and direct lenders. But overall 1Q21 seemed like somewhat of a carryover from 4Q20, not as busy, but still a pretty strong quarter overall. Now how much is the pandemic impacting things at this point? Did the surge we saw over the winter months, more lockdowns, et cetera, impact activity? Well, what the lenders responded with, 61% said the pandemic is currently not having a profound impact on business. And you can see again on that chart on the left that the responses are split a little bit between the banks. Were more heavily favored towards saying there was more of an impact there than direct lenders. So how does all this kind of factor into what lenders are seeing in the pipeline for 2Q21? And pretty positive responses here. 81% of direct lenders and 75% of bank lenders say there's either very strong or sufficient sponsored M&A in the pipeline to keep them busy in 2Q21. Now, in the non-sponsored, bank market, what's keeping them busy, if you look on the chart to the right, it's going to be refinancings and opportunistic deals. So that's kind of, how the survey kind of panned out as far as, what happened in 1Q21 and what we're looking for in 2Q21.
Yeah, it's kind of interesting how certainly from the banks and the direct lending side, you're certainly seeing different impacts of COVID on portfolio performance. And certainly it's been a very different bifurcation of sectors in terms of being impacted by COVID. You've got your airlines and your travel and entertainment businesses certainly have been impacted compared with maybe some of the private credit traditional targets of software and healthcare, manufacturing. And so just interestingly, that kind of optimism beginning the year perhaps going to play out for the rest of the year. I turn to you, Andrew. Can you talk us through a little bit more about how you're seeing and how maybe private credit managers are seeing the rest of the year pan out and the kind of excitement that's taking place?
Sure. So there's been a number of conversations with fund managers over the past 3 months or so, and there's a lot of reason for optimism as how they see it. As you mentioned, the vaccinations are ramping up, and businesses have adapted to COVID better than a lot of people anticipated. Antares did a survey that I thought captured the optimism pretty well. Over 80% of respondents had said that they don't see a recession in the next 12 months as likely. And then LBO activity is expected to pick up. You have 64% of private equity firms seeing more LBO activity and another 32% saying it'll be flat. and then only a small 4% expected to decrease. So that points to a possible increase in deal flow for private credit firms, given that they rely so much on private equity firms for their deal flow. And then you get to add-on activity, and you're looking at something that's even more positive. 69% see there to be more add-ons, and then 31% see add-ons remaining about flat. And nobody expects there to be fewer add-ons. And given that middle market buy and build strategies have been a core investment thesis for many PE firms, as well as private credit lenders, that that additional add-on can be seen as a net plus for private credit lenders. And then you look at the types of financings that private equity firms want to use. Unitranche and club deals continue to be popular, with 41% saying they plan to use a club deal over the next 12 months, and 40% saying they plan to use a unitranche. So the syndicated market, while it might see a slight increase from the last 12 months, still tends to be a minority of the deals. One point worth highlighting, though, is that you're seeing a number of borrowers that responded in the survey saying that COVID was still impacting their business. So that's something that you should keep your eye on. Even though they've managed to make it over the COVID hump, we're not necessarily out of the woods yet.
Yeah, it's it's certainly interesting to see the unitranche market share expected to kind of certainly hold up in that development, and certainly from a lot of conversations I know you had, Andrew, and myself with fund managers, is that we're very much back to pre-COVID. Certainly when January, February 2020 was certainly very much a market favorable to sponsors, and over the summer we saw perhaps a kind of pendulum swing towards the lenders. But it's kind of interesting because I think where maybe private equity firms may be looking at is maybe a still muted M&A market, and to sort of lock in their returns. Dividend recaps has certainly been a big interest. So I spoke with Ian Walker at Covenant Review very recently, and he was particularly concerned about a pick your poison clause for lenders, is what he called it so colourfully. And simply, I mean, to not get into too much of the details of it, pick your poison clause allows for incremental debt based on unused capacity for dividends. So simply, a private equity firm can pivot towards using dividends where maybe clauses in the past may have restricted them. He called this eye-popping, and further sets alarms in the part of market with these egregious provisions typically seen in the broadly syndicated loan market. He attributes the kind of push for that towards the presence of large sponsors, showing that, you know, your large private equity sponsors are looking further down the food chain for their own assets. So certainly there's kind of a lot of shifting around going along strategies for private credit and private equity side. And so, Andrew, just going off that, whilst maybe there might be sort of optimism from many lenders about deal opportunities, you found that some are a little bit more pessimistic.
Yeah, so there was a recent Fitch report that I found interesting, and it talked about BDCs broadly, but it really got to the core of what dividend coverage could look like for those funds over the course of the next year. And they said, you know, certainly the picture is brighter than it has been, but there's still this economic uncertainty, and there are a couple factors that would put pressure on BDC's net investment income, which is used to cover the dividend. And first off is that lower interest rates obviously mean a lower NII, net investment income, given that most of the assets that BDCs hold are floating rate. So you'll see that have an effect. And then there's also the potential for higher non-accruals or higher PIK interest, both resulting in lower income. And this really comes from potential economic certainty. You're looking at a landscape that might have more restructurings in the near future, just given that some businesses that might have had to deal with workouts last year now have to go back to the table and say, we made this adjustment last year. How are things going now? And if things still aren't going well, the question comes: what are folks willing to do in terms of accommodations to loan documents, and is the private equity sponsor willing to put in more capital? And if they're not, what do you do then?
Yeah, absolutely. I think, your traditional private credit manager will say that they are quite immune to some of the kind of macro volatility, but as treasury yields kind of reach sort of 1.7%, as many kind of fear inflation, that might have a knock-on effect to raising rates at the end of the year by the Fed. But that's certainly a debate amongst the macroeconomists. Obviously, a raising rate environment benefits your BDC's private credit. So on that note, I'd like to kind of thank Andrew and David for joining us on the Refinitiv LPC Middle Market podcast. We'll certainly, please do watch this space for further updates on the market and coverage of mine, David and Andrew's work on a loan connector. Thank you.